Guys, welcome back. My name's Aaron. This is Czar Finance, episode 35, Fundamental Analysis, the Cash Flow Statement. Okay, so when it comes to the cash flow statement, this is the final part of the three-part series for fundamental analysis. The cash flow statement basically refers to how much cash comes in and how much cash comes out of the company, what's flowing in and what's flowing out of the company. The cash flow is one of the most important fundamentals of the fundamental analysis of finding out what a company's true assets and liabilities and all that sort of stuff, whether they're making a profit or not making a profit are. Okay, so when it comes to this, the cash flow is basically released in quarters throughout the year. So 4 quarters make $1. So 4 times throughout the year they release a cash flow statement that indicates how much money that is coming into the company, how much money is going out to the company, and that sort of thing. So, whoops, sorry about that. The cash flow comes in 3 main sections. The first section is the operating activities, or what it costs to operate the expenses. What is actually this, which is basically the sales of the company, all the sales that are being sold, and how much it costs to sell those products in the process. So that's one part of 3 parts of the cash flow statement, is the operating activities. The second part is the investing activities, which is basically anything that they're investing in to make the equipment. So we're talking, or make the product, I should say. It's the manufacturing equipment that they're using. Is it computers? Is it manufacturing tools? Is it the thread that they use to make, say towels or something like that? What is the materials that are being used to make the product is the investing strategies activities sheet that is also part of the cash flow statement. So the first one was operating activities, the second one is investing activities, and then the last one is the financing activities, which is basically stating the ongoing of cash associated with outside financing activities. Typical sources of cash flow would be raised by selling stocks and bonds or other bank borrowing accounts. So basically, what are they doing with the extra money that they have? Are they investing in new companies? Are they borrowing from banks? Are they to reinvest in the company, taking loans out, things of that nature? So again, the top 3 operating activities, investing activities, and financing activities are the 3 types of fundamental analysis that comes through the cash flow statement. Now, one of the neat things that people often tend to look for is called the FCF. Again, it's the FCF, which is the free cash flow statement, which basically signifies what is the overall arching positive or negative aspect of a company. The free cash flow statement basically lets you know that when it's all said and done, is the company, can they pay off everything that they owe in debt? Can they pay off all their machinery? Can they pay off any stocks that they have? Can they buy back all the stocks that they wanted to? Can they sell everything and there's no debt, basically? Are they positive or negative when it comes to the cash flow statement, And if you look at that on a deep down rooted level, you can see whether the company is very healthy or toxic. So a lot of investors, shareholders love to see companies that can afford to pay off all their debt, and if they had to, in one shot. Is the company able to wipe their debt clean, if they had to, by paying any loans that they might have, any equipment that they might have, issues, materials, and products or sales, etc., for marketing, whatever. Could they pay it all off and then have a surplus of extra money that they can either give back to the customer as dividends or buy back stocks or have investment for R&D for new materials that can come back, kickbacks to the shareholders. Basically, it's a way to show whether the company is profitable and clean and they're running the books very well, or they're not really having a good cash flow funds returning back to them. And when you think about that and look at that sort of a thing, there are companies that have it. It is hard to find the companies, but when you find a company that does have a good free cash flow statement that shows that they're in the positive and that they can pay off everything that they own, that's a company you need to invest in, because those are the companies, those are the movers and groovers that are really worth investing in, because they take their money and they're putting it towards good use. They're not taking the money, putting something out there that's eventually going to crash and burn, and then, oh no, we can't pay our investors back, so we can't pay our loans back. It just shows that they have good fundamental analysis with their cash flow, and they know what money comes in, where it's going to, and where it's coming out of, and then in the end they could return it back to the company in dividends or other shares or etc., or have discounts or company outings or buybacks or give backs to the people who invested in them in the begin with. So those are things to look for. They are out there. They're hard to find, but look for the FCF. Again, it's Frank C. Frank, if you will, FCF, and it's a great way to look at that. The last thing to look at here I wanted to talk to you guys is what's called a 10K and a 10Q filing statement. A 10K basically means it's when the fundamental analysis comes out once a year, and they do the filings for the company, the overall big picture of positive, negatives, who are the investors, who are the managers, how many employees do they have. It's the big statement that they have for the company. It's the overall arching paperwork that you can Google on any company. Just go and type in anything on there, and just type in the name of the company, and then type in space 10K, and it'll give you the quarter. Now it comes out, not quarter, but once a year. It comes out annually, and like I said, it just shows the overall arching growth of the company, whether they're doing good, bad, sideways, whether they're investing, how many products they have, how many things have sold. It's just the complete data sheet, basically, as a 10K filing. Now the 10Q, basically the Q, for reasons of the letter Q they chose, is quarterly. And it's often filed 4 times a year, but technically, if you look at it, it's 3 times a year because it's quarterly, because the 10K is the 4th one that they actually add at the beginning of the year when it's coming timing. So it's filed 3 times throughout the year, and it's every quarter, so 3 times a year, technically 4, because the 4th one is the 10K, like I just said. And that just shows the statements of how they're doing so far. Where are they right now? Are they doing well? Are they on track? Are they not on track to where they're supposed to be? How are things going? Is a market that maybe had a hurricane or an earthquake, is that affected their company this quarter? Did they get great investments this quarter? Is the money doing certain things? So again, 10K is for 1 year annually. It's a quick overall arching view once per year, and 10Q is filed 3 times a year for the quarterly statements of a company's file. And again, you can type in any company you want, space 10K or space 10Q, to find out where their quarterly statements are. It is public knowledge, and it's great to see the findings of a company's basic assets and liabilities, and see if they're running the books good, or have a good positive cash flow. So again, my name's Aaron. This is Czar Finance episode 35. Thanks for joining me today, and I hope you have a great day. Take care. Next week we're going to talk about, on episode 36, we're going to talk about technical analysis, which is one of my favorites, because I like to see things visually and not look at all the technical aspects of things. But it is to each own, and I wish you the best of luck. Okay, bye.